After watching silver move up 150% on the year and gold about 80%, even though it gets virtually nothing in the way of media coverage. It's funny, you have Reuters write about it and simply say that silver had a great run, and they call it silver the devil's metal is the name of the article. It had a great run, but they call it the devil's metal. Everything that you get from the media, what little you do get, is usually cast in some sort of a shadow that speaks to either the run is past, that it's overbought, technicals look bad, this is what happened in 2011, or this is what happened in 1980, time to lighten the load. What's different this time than in any market I have ever seen related to precious metals is the number of deliveries. We are seeing massive deliveries into COMEX, and to me that is, all you really need to see. And I don't mean to be trite in answering that question. I'll start by saying, before I give you the numbers, that the people that are doing this are the most well-funded and, I think more importantly, well-informed traders in the world. And if we, for example, realize that a silver COMEX contract is 5,000 ounces and a gold COMEX contract is 100 ounces, the amount of deliveries that I'm about to explain to you, I think you'll understand that these are numbers that, these are numbers that the people that are doing this, I believe, don't do these things just for the heck of it. And they, I believe, have a good idea where things are actually going. So if we look at the month of December, we start to see a trend that we've seen now for going on 15 straight months since November of last year, when Trump won the election. But every single month we're seeing massive deliveries. In the month of December, we saw 3,706,000 troy ounces of gold issued and delivered on COMEX, 3.706 million ounces. And you're into the billions of dollars. But an all-time record for the month of December, 64,730,000 ounces of silver delivered. They say issued and stopped. That means actually delivered to the COMEX. Some leaves the COMEX, some stays in the eligible category, not for sale.
Recent delivery volumes are extraordinary by any historical measure. In a single month, tens of millions of ounces of silver and several million ounces of gold changed hands physically, representing staggering sums of money. Even in months traditionally considered quiet, deliveries have remained elevated. This consistency points to a sustained trend rather than a one-off anomaly. The critical question is not just how much metal is moving, but why. These buyers are willing to tie up capital and absorb storage costs, suggesting they expect tighter supply or higher strategic value ahead. Markets rarely send signals this loud without reason.
The bottom line is, if we just look at the month of December, what you're seeing is billions and billions and billions and billions of dollars of metal delivered into the COMEX. So we got 64,730,000 ounces of silver in just 6 trading days in the month of January here, which is a non-delivery month. We've already seen pretty darn close to 36 million ounces of silver delivered and several 100,000 ounces of gold delivered in just the first several days. And when you think about this and ask yourself, who the hell's got this kind of money? So far in the month of January, exact numbers, 6,690 contracts delivered, about 33.45 million ounces of silver. And in terms of gold, it was almost 600,000 ounces of gold have been delivered in just the first week of delivery on COMEX. And so for me, what's really different above all else is that, this is a situation where continuously we're seeing the most well-informed traders here in the United States go to great lengths to stand for delivery on precious metals. That's something we never saw before. And the U.S. has become a net importer of gold after being a net exporter of gold for the last 40, 50 years. So I don't know, I would say that to me is the most different characteristic I've ever seen ever in this industry, where COMEX has been more than anything a vehicle for speculation and exports. Now all of a sudden we're seeing deliveries that are so far outside the realm of what is normal that it's impossible to ignore. And what bothers me more than anything is the lack of mainstream coverage by this, because this should be mainstream news. Who's standing for delivery? Who's bringing in billions and billions and billions and billions every single month? Who's doing it and where's it going and who's paying for it? Who's got enough money to buy 100 million ounces of silver in the last 40 days and take delivery of it? So interesting times for sure, and that to me is what's most different about everything.
Despite the scale of these developments, mainstream financial coverage remains muted. When precious metals are mentioned, they are often framed as speculative, volatile, or nearing the end of a rally. This contrasts sharply with the data emerging from exchanges and vaults. At the same time, the United States has quietly shifted from being a long-term exporter of gold to a net importer. That reversal alone should raise eyebrows. Meanwhile, ownership of physical metal among the public and institutions remains remarkably low. The disconnect between market behavior and media attention suggests this story is still unfolding beneath the surface.
The sentiment by the public, yes, it's starting to grow. It's hard not to. I mean, you would think that after watching silver move up 150% on the year and gold about 80%, even though it gets virtually nothing in the way of media coverage. It's funny, you have Reuters write about it and simply say that silver had a great run, and they call it silver the devil's metal is the name of the article. It had a great run, but they call it the devil's metal. Everything that you get from the media, what little you do get, is usually cast in some sort of a shadow that speaks to either the run has passed, that it's overbought, technicals look bad, this is what happened in 2011, or this is what happened in 1980, time to lighten the load. I don't know. I think that the overall allocation to precious metals in the matrix from Joe and Jane Sixpack to the Harvard Endowment Fund is still very, very small, less than 1%. Rick Rule always says 0.5%. Maybe it's a little bit more. It's expanding, but not anywhere near where it should be based upon not only its performance, but what's happening with the dollar, the de-dollarization, what's happening with the treasury market, what's happening with the labor market, what's happening with the indebtedness. I think that people look at gold and silver as an investment, and those who look at it from the outside, I look at it as wealth. And I would far, far, far rather hold my wealth in gold and silver, which have been slowly and steadily appreciating for the past 25 years, just about outpacing everything, than holding it in dollars, which acts more like a melting ice cube in terms of its preservation qualities. So I don't know. I think that the public will wake up, but still far from, I would say, a sentiment indicator that's off the charts. It's just starting to wake up from hibernation, so to speak. So yes, getting better, but still a long ways away from where it should be, especially when you look at the action on COMEX, which, again, the most well-funded and well-informed traders on the planet, and I'll highlight well-informed, they know where things are going. People don't spend hundreds of billions of dollars just for the hell of it. They know where this is going. And who is it? Is it the U.S. government? Is it Warren Buffett? Is it Tesla? Is it Samsung? Who is it? These are the questions people should be asking themselves. But that alone should tell you the answer. At that level, they understand and they're prioritizing physical possession over anything else. And spending that kind of money tells you they're not doing it just because they want to capture a trade. They're doing it because they see it as being pivotal to where we're going.
For many participants, precious metals are no longer viewed as short-term investments, but as vehicles for preserving purchasing power. Over decades, gold and silver have steadily appreciated, often outpacing inflation and rivaling equities on a risk-adjusted basis. In contrast, fiat currencies steadily lose value over time. While price corrections are inevitable in any bull market, these pullbacks reflect positioning and leverage, not sudden surpluses of metal. In an environment of global debt, currency debasement, and geopolitical uncertainty, physical metals serve a different role. Less about speculation, more about financial insurance.
To me, Look, I think it's always wise to, especially in a market that has moved up the way that this one has, I think, yeah, I mean, it's probably wise to have some sort of caution. Silver and gold can pull back, right? I mean, after a vertical move, oftentimes you'll see what's called a air pocket or a sharp air pocket. Profit taking, margin pressure, they keep raising margins, right? Headline risk, it's gone up too fast, or it's overbought, you name it, you'll see it. A $10 to $20 correction in silver or a $100 correction in gold is not only possible, it's normal in the bull market. And, you know, it was up $6-7 yesterday. You didn't hear anyone complaining about it. But it's the underlying conditions that got us here more than anything. And I think I would make a distinction between thesis risk and price risk. And in other words, you have tight physical availability across the globe in all the major exchanges, coupled with massive delivery demand. That's the thesis. In a paper market that's been asked to settle real world demand in real metal that it may not actually have. You look at what's happening in London, the rehypothecation is beginning to break the system. So yes, if you're asking, in other words, could gold and silver drop next week? Of course it could. And I'd actually be surprised if we didn't get some sort of a violent pullback along the way. But if you're asking, does the pullback change the bigger picture? I don't think so. In fact, to me, and I'm not saying this as a salesman, I'm saying it as in a market like this, if you think about it, a dip is a gift, because these dips will be driven by positioning and leverage, not by a sudden surplus of metal. When you have the whole world rushing to accumulate this stuff, the physical metal that has been levered on the exchanges, my simple advice is, you know, if you're a trader, trade it. But if you're trying to protect your purchasing power, the risk isn't that silver goes from 80 to 70 or that gold goes from 4,600 to 4,500. To me, the risk is waking up in a market where you can't get what you want at any reasonable premium or any reasonable price, and the price you thought you'd be able to pay is gone. So I guess the real answer is short-term caution, absolutely. Long-term conviction, 100%. And they ought to be able to both be true at the same time. In my mind, they are.
The enthusiasm surrounding technology and artificial intelligence masks deeper structural weaknesses. Equity markets are heavily concentrated, with a small group of companies driving most gains. Valuations are stretched, dividends are minimal, and economic growth beneath the surface remains uneven. At the same time, government debt and unfunded liabilities continue to expand, while automation threatens both blue and white-collar employment. Insiders and major investors have responded by reducing equity exposure and building cash reserves. Against this backdrop, the steady accumulation of physical gold and silver looks less like a bet and more like preparation.
I don't know how you grow into those valuations in an economy such as ours, where the majority, by the way, of the appreciation in the indices are held up by 7 stocks. The breadth is as bad as it's ever been. And so when you talk about really a AI revolution and a tech revolution leading the way, and not to mention in the S&P 500, which again is, when you measure price to earnings ratios, when you look at the dividend yield, they're pathetically low from a historical standpoint in terms of value. But when you look at this great revolution of AI and a S&P that was up under 20% last year, well, silver was up almost 8 times that amount, and gold was up 4 times that amount. Quadrupled it in the face of the biggest tech boom ever since the internet. In terms of how would it affect the stock market, and I don't think that this is something you just grow into. I mean, because where's the growth, by the way? When you look at our country, let's just be flat out honest about it. We have a $38 trillion debt. We have almost $200 trillion in unfunded liabilities in Medicare and Medicaid and Social Security and government military pensions off balance sheet. A trillion seconds ago was 31,688 years ago. Ray Dalio just came out and said that 60% of the United States has a reading literacy rate below that of the 6th grade. We're uneducated. Our manufacturing, what manufacturing? We don't make anything. So we're broke, we're uneducated, we don't make anything. AI's here, which is going to kneecap 40-50% of all the entry-level jobs within the next few years and take away a lot of the white-collar jobs, such as being an accountant, analyzing a balance sheet for a real estate investment trust like my son was doing at Price Waterhouse. He works for me now, but what do they need a kid getting paid 80 grand a year to analyze a balance sheet when AI can do it in 1/10 of a second for free?
Sharp corrections in metals prices are not only possible, they are normal. But volatility does not negate the broader thesis. The real risk may not be a temporary dip in price, but a future where physical metal is scarce or available only at significant premiums. As equities appear increasingly disconnected from economic fundamentals, precious metals stand out as one of the few assets grounded in tangible reality. This does not require abandoning caution or timing altogether. It requires recognizing that return of capital may matter more than return on capital in the years ahead.
But this goes on through all sorts of industries. So you look at how do we grow our way out of this problem? We have fiscal irresponsibility, we're broke, we're uneducated, AI is coming, we don't make anything. Do you see that there is a problem here? And that's kind of been my thesis about how you bring back manufacturing for a while. But the bottom line is simply this, that the market is wickedly overvalued. There is a disconnection between Main Street and Wall Street. And I don't think that changes anytime soon. And you ask what would happen to, to the precious metals in the face of a market sell-off? Well, I mean, ask yourself this, by the way, before you even think of that. Why is Warren Buffett sitting on $400 billion in cash? Why did Bezos sell $7 billion in Amazon? Why did Zuckerberg and Jamie Dimon and why are they selling? And why are the insiders for most of the year last year selling between $1 and $3 billion a week in equities? Point of it is that the insiders are already tiptoeing out as the public is all in. Largest percentage allocation, mom and pop, retail public to the equity market ever. Largest percentage of option investment ever by the retail public, and largest amount of margin debt ever by the public, about $1.5 trillion. So you got the public all in on margin, speculating through options and on margin. And so as the insiders are leaving, and at the same time you're seeing the biggest money in the world stand for delivery in metals and no one knows who it is. What could possibly go wrong in all of this? What I will say to you is that the public will be left holding the bag, and the big money is already quietly tiptoeing. Look, the central banks have been doing this for years, and now you have the big traders here in the U.S. I think it's inevitable that we see a pullback in the equity market. And what does it do? I don't know what it does to the precious metals market. It is inversely correlated, they say. You would expect it to go much higher, but all I can say to you is that this is a time, I believe, to stand away from the equity market that has risen to tremendous heights, has done so on the back of 7 stocks, has done so as the economy underneath it does not support its growth, in my opinion. So return on money is nice, return of it's a whole hell of a lot better, but you look at gold, it's outperformed the S&P for 25 years, average 9.9% versus 9.6, just barely, but that's even with dividends reinvested the whole way. No one does that. And you look at the last several years, gold is starting to pull away from it, so is silver. And I would just simply say to you that this is not the time to be riding this late stage in an equity market that's paying nothing in the way of dividends, that is overextended, and is detached from the real economy on the back of an inverted pyramid. In other words, 7 stocks holding up the other 493. I don't know. I think it would be very bullish for gold overall.